Good evening, and thank you for joining us for United Policyholders Program today on post-wildfire rebuild financing. Let's start with just a little bit about United Policyholders. We're a national nonprofit that serves consumers of insurance in all 50 states. We've been doing this for 32 years, starting with Oakland Hills wildfires. We're, as I mentioned earlier, we're not for profit, not for sale, and what that means for you is we're funded by donations and grants. We don't take money from insurance companies so that we're able to be this objective voice in the space. One of the unique things about us is our volunteer corps with our volunteer presenters today, volunteers who either have personal or professional expertise in disaster recovery and insurance. We call them Team Up. Today we have with us our small professional staff, myself, Annie Barber, and Carolyn Winter, who is the woman behind the logo mask there. We've got our partners from Exchange Bank and from Elevations Credit Union. And Annie actually originally was one of our volunteers and then came on the staff. She's part of that group of previous catastrophic loss survivors who want to pay it forward. And so we have 3 programs: our roadmap to recovery, which gives you, like today, guidance on insurance, restoring those assets and getting back home. Our roadmap for preparedness, where we take those lessons learned to help households and communities reduce risk and be resilient to disasters and community and adversity with the help of insurance. And then advocacy and action, where we fight for insurance consumers' rights and protections. For all of you, no matter what your disaster, if you go to our disaster recovery help library, you'll be able to find the disaster specific to your community with a set of step-by-step guidance that helps you through the process, connects you to resources, provides sample letters and examples, and also has our Survivors Speak series, which is very helpful. If you go to events, you can see upcoming workshops and resources available too. And if you'd like to follow along on today's event, please go to events and you can download the PDF here of our slide deck. And without further ado, we're going to start with just a reminder that recovery is a marathon, it's not a sprint. And so, Kevin, you were just mentioning that there's this concept of you slow down, take the time, because you will help finish faster. This workshop is intended to be general guidance only. It's educational. We're not providing legal or financial advice. And our speakers are volunteering their time as educators. And so our panel today, myself, Valerie Brown, I'm the Deputy Executive Director of United Policyholders. We have Kevin Smart, Senior Vice President of Residential Consumer Lending Management at Exchange Bank in Santa Rosa, California. Todd Pioch. Did I get it? Pioch, oh, sorry. So close. Another Senior Vice President, Commercial and Business Banking at Elevations Credit Union in Boulder, Colorado. And then Annie Barber, who is our California Roadmap to Recovery Liaison and also a 2017 Tubbs Fire survivor. And thank you all for joining us today.
Thank you.
And so our topics today, we're going to deal with a deep dive on 4 of these: mortgage-related decision-making, paying for construction with your insurance funds, escrow account best practices, things to be aware of there, how to handle progress payments, fund control, construction quality control, tackling change orders, and knowing your loan and other options for helping finance the rebuild for an underinsured home. And so we're going to start right now with mortgage-related decision-making. And just a reminder to all of our presenters today, feel free to jump in at any point if you have anything that you'd like to say. And so these are the questions we recommend you ask before you rebuild. How much is still owed on your home? If you're underinsured, how can you get what's owed to you? Are you going to need a new loan? This publication here is a resource for you. And so anything anyone would like to add before I go to the next slide?
Yeah, this is Kevin. This could be one of the more important slides or topics of the discussion tonight. And this is where I saw in 2017 and beyond, really a need for the homeowner to slow down and figure out exactly what they owe on their home, what their insurance covered and didn't cover, and that's usually the longest path or part of the path to understand, because you really start having to factor in numbers. It all ends up being a numbers game, which is horrible to say because this is your home, your life, your personal possessions, but it does at some point turn into dollars and cents, and this is where slowing down helps you get through the process.
Right, and slow down in making those thoughtful decisions, right? Because what you don't want to do is jeopardize your long-term financial future by rushing forward on. While it's your home, it's also for most people, it's one of the most expensive business decisions they're going to make, financial decisions. So being aware of that and taking the time to do that. All right, so going back to knowing what's available to you, right? So you want to try to get paid as much upfront as you can from your insurance company. For a lot of people, you're looking at bringing over your contents money to help with your rebuild. Unfortunately, that's a very common thing people do when they're underinsured. Getting your lender, your lender should be releasing any amount of insurance proceeds paid greater than your principal loan. That's, at the beginning, right? Getting paid as you're drawing down for your construction is a different issue. We'll talk about that a little bit later. And just focusing on, the communication with your lender and contractors is critical. So as you're moving forward, making sure that everybody's on the same page and what everybody considers, 50%, 75%, what those draws look like.
And I'll interject here just real quickly. So your lender, in many cases, will try to pay off your mortgage. They no longer have collateral on your house, of your house being there. And you really want to express to them that you don't want them. They can put that in an escrow account. They can secure those funds. What you don't want to do is have that loan paid off and not qualify for another loan if you need it. So it's really advantageous to do an escrow account, have the funds taken out of that. And if you have money left over and you want to pay off your mortgage, feel free. But if you don't have a source of income, you don't have a W-2, you're on Social Security, that will make that process difficult if you run over what you're expecting.
And that's a key message. Thank you, Annie, for bringing that up. The idea that for a lot of people, it feels like to save money, they need to pay off that loan. But if you don't have the means to qualify for a loan to replace your mortgage, working with your lender to rebuild your house is going to be a key part of this equation. Todd, Kevin, anything to add there?
Yeah, one of the important lessons we learned as a bank after the 2017 fire was in California, there's a deed of trust that actually, that's a security instrument that the bank has to secure the collateral. And that deed of trust is a really important document because it describes what a bank can and can't do or might want to do. Being a small community bank, we had to dive in. No one ever reads it. It's on page 8 of a 13-page document. But when you get in there and read it, it really goes through the steps of what a bank can and can't do. And this is when the decision needs to be made to slow down and say, don't pay me off or pay me off, because every situation is different. But having a safe spot before a disaster happens of these kind of documents really gives you a little bit of a roadmap. And Annie can talk about knowing your insurance policy and not just having the declaration page, but all 40, 50 pages that go behind it. So know your paperwork, or at least have it in a very safe place to be able to prepare for a disaster.
Thank you for that. And then at the bottom of the slide here, we've got our publication on getting your mortgage company to release your insurance proceeds, which is a sampler example. Kevin and Todd, is there anything you'd like to share about how, I know it's very specific to your institution and your state, but what are those best practices to get people in sync, to have that level of communication with your lender and contractor to move people along?
So keep in mind, you'll probably be talking to two different lending institutions. One may be your mortgage holder, but then if you're using a construction loan, it'll be a different lending institution. And a lot of times, if you can get those two parties to chat, they'll speak the same language and be able to probably come to some type of resolution, because a lot of mortgage holders don't do construction financing. So you may have to have the interaction of the two parties, but they speak the same language 9 times out of 10. So getting the two to connect may be advantageous.
And I
you.
would, yeah, and I would add to that, if you do experience a disaster and you do have to deal with your lender, write down everything, take incredible notes, the numbers you have called, the people you have spoken with, because the goal here is to try to have as few points of contact as you can have with your lender, insurance company, etc. So that's one thing we learned as well, trying to give a homeowner just one person to talk to, whether it's one call or 100 calls. Then that way there's a history of what's been said, what's been talked about, what's been agreed upon. I think that's really, really important.
And Kevin, would you touch on, and it may be something that's forward, but would you touch on if your lender says that they will not give you a construction loan with a certain builder, based on experience that you've had?
Yeah, it's kind of an interesting topic, but lenders can be wary of certain builders and uncomfortable with the financial stability or instability of a builder from past experience. This process is going to feel like a part-time or a full-time job for the homeowner, because there's so many moving parts, there's so many pieces of the puzzle, and when you move forward and find a contractor, and great, I found a contractor, I really like them, you do have to go to your lender and say, this is who I'm trying to work with, because the lender is going to vet and require information from that builder, which is super important for the homeowner. You want your lender to be in your on your team, as well as your contractor and everybody else. But if you're borrowing money, you want that lender to know exactly what's going on, because they're going to serve your best interest along with theirs, because they want that house rebuilt, just like you do. So Annie, that's a great point and something important to remember.
Well, thank you. One last topic here for section 1, tracking down that authorized signer. And so I know this is an area that a lot of people are struggling with right now. They can't find the person to help them get the proceeds released. So any tips on how to people to connect to those authorized signers and then keep that process moving?
Todd, do you want to jump in there? You have anything?
No.
For me, it goes back to trying to get that single point of contact. When a lender gets flooded with insurance checks, because they will, and they do, it's important to be able to track that movement of that check, to make sure it gets applied to your account, and then the rest of the proceeds to come back. So I can say in my area, banks unfortunately have gotten a lot better at figuring this stuff out and coming up with policies and procedures. When it happened in 2017, we lost 5,000 plus homes in one night, basically a day and a half. And we were flooded with checks, and the bank stopped. Again, they slowed down and figured out a policy and a procedure, and then followed that to make sure that they could control the flow of money. So what I would suggest to a homeowner is, again, make this a part-time job, concentrate on this as best as you can, and get that one point of contact to make sure everyone's following the same path.
Right. And if you can't figure out that person, maybe start with your, a customer service management level person to connect you to the right person.
Yeah.
All right. And now we're going to talk, Annie, that leads you right into paying for construction with insurance funds. And so just to reiterate, paying for your construction at best practices, going back to the beginning, when we're talking about with insurance, you're calculating the cost to rebuild what the home you had, what it should have been insured for, up to your policy limits, right? So you know what it's going to cost, what you have available. You get an estimate from either an estimator or a builder. These are two publications that will help you do that. And then once you have that information, you're looking at finding a builder that will build what you have, what your funds are. So again, knowing what your scope of loss was, how much funds you have to work with, and then moving forward with that piece. Escrow accounts and fund control. And Annie, feel free to jump in here at any point. Just a few things to point out. They're required if you have a mortgage. They provide that extra protection to the homeowner, meaning the bank's going to help you with the process with fund disbursement, inspections, collecting those lien waivers. And I think the most important thing is just be aware of what you don't know. Like Kevin said, there's a lot of different tasks that you're juggling right now with the rebuilding process. And an escrow account just gives you that added protection that somebody else, like Todd said, is on your team making this work for you. Annie, anything to add here?
Yeah, so I live in the same world that Kevin Smart lives in. In 2017, after our disaster, we really didn't understand the whole escrow accounts and how to be safe with your money. But some people learned the hard way. I was fortunate enough that I used a builder who required an escrow account. And what that did was that secured the money. The builder did not get any money until they had hit certain milestones. So an inspector would come out and say A, B, and C is done, and then they get a check. What that ultimately does is that protects you, because your builder will never get farther along than what he's paid for, or vice versa. So if your builder is at 50%, he has 50% of the money. In the area that I live, there was a lot of builders who did not have the resources, did not understand disaster rebuilding, or didn't have the best moral fiber. And they would kind of hold you emotionally hostage to give them more money so they could continue the build. And ultimately, there was people who ended up with 50% of their build, and the builder had 80% of their money, and the builder walked. So the escrow account is a great way to make sure that that doesn't happen. And at least if your builder does walk, or you have a problem with your builder, you still have enough money to finish your build.
Valerie, can we stay on this topic for a little bit?
Absolutely.
Because unfortunately, the pitfalls are where we obtain all our knowledge. As Annie mentioned, the day, the night, the next day of the fire, it turned 51, almost 5,200 homeowners, more than that, but into contractors in a way. And a lot of people obviously have never built a home before. They go out, they see a home they like, they buy it, they're good to go. And this is where we saw a lot of the pitfalls and the challenges with the homeowner in a very sensitive state or situation, and the builders coming in droves. And we saw a lot of homeowners handle the insurance funds, got them to the lender held on or paid off the loan. That was good. They got their other funds and they immediately gave it all to a builder, and the builder started building, unaware of what a timeline, what an expense could really be. And you're going to hear a constant theme from me, so I guess I'll apologize again, but this is where slowing down really helps you with the process. Slowing down and picking a builder, and figuring out what you want to do. It's 2023. We are still being approached by people from the 2017 fires who are finally able to figure out and decide on how they want to move forward. And there's nothing wrong with that. Some people did it immediately. Some people are doing it now, and then you have a lot of people in between. But this is where we saw most of the challenges within the rebuild of our city and our county.
Todd, anything you'd like to add? I know you're only a year and a bit into yours with the Marshall Fire, so.
Yeah, and unfortunately, we've seen similar situation that Annie was referring to already, where builders have taken funds from victims on the Marshall Fire, did very little, and then just left town. So Kevin's correct. You know, banks, credit unions are going to be somewhat concerned about who you're giving your dollars to. Most builders, I mean, most credit unions and banks have almost what you call a approved builder list that they've worked with, they are comfortable with, and stuff like that, and have a prior track record. I think one of the things that we hear is that people are trying to determine the cost to build, and are probably extremely surprised by the cost to build to date. And I know in our market, several builders have gone out there and have websites that can give you some idea regarding what to expect when it comes to trying to determine costs. And at least it's kind of very transparent that they put out there for this model home, for this this is what the cost is going to be. So it gives you somewhat of a comparison where you have at least a base model valuation of what it should cost. That way you have something to compare to if a builder is telling you it's going to cost you $2 million, and some of these websites say, hey, it's only going to cost you $1.2 million. You should be asking some questions regarding that. And I understand most people in this market have never done a construction loan, have never had to rebuild. So there's always a lot of questions.
Well, and most people did not plan to build a house. That's the key notes, right? This is not, very few people were planning to build a home or had built one in the past. So this is a whole different skill set and just a lot of decisions to be made in an area that you don't want to be making decisions, quite honestly.
And the other thing I would encourage people is that we get a lot of calls from people that just assume they are underinsured, but they assume there's no opportunity to rebuild. And surprisingly, there usually is. You can find a path 90% of the time, I think, or 95% of the time. So, don't hesitate to just reach out and ask and give full disclosure. Here's how much money I got. Here's how much I make. Here's da-da-da-da-da. And usually on 5 or 6 questions, you could pretty much determine if there's a path to rebuild and get you there.
Let's like 2 slides in, 2 more slides. I'd like to do a little deeper dive on that topic, if you don't mind.
And let me just add real quick that as fire survivors, we are really not equipped with everything that's going on to build a custom home. And many people who decide to build a custom home take 3 or 4 years, and they go to an architect and they take their time and they go and look at homes, and that becomes quite a challenge. So just bear that in mind, that is taking on a bit more emotional and your time, your everything. Making decisions with Firebrain is not always easy. And don't think We talk to people all the time and they say, well, if I use a builder in the area, not someone from out of town, that they're safe, and that it just does not hold true. So you need to vet your builder really well.
Yeah, and we'll talk about that piece a little bit more in depth. Just again, talking about managing your insurance funds, you want to make sure that you've structured that contractor agreement, draw schedule, at least to be consistent with, or hopefully more favorable than, your lender disbursement schedule. Because again, like Andy said, you don't want to let the contractor get ahead of your agreed draw schedule. I think Carolyn's already put the planning for insurance payouts publication in there, and then what to do with checks from your insurance company is another publication. And just to be frank, if you've got a mortgage, you're endorsing it, you're turning it over to your lender, and then it's in their account and hopefully in that escrow account, right? Now, options to pay for your rebuild. All right, so let's dive into this a little more. So your insurance company is going to manage the payments to your builder if you have a mortgage, your lender's in the mix for your dwelling piece. So you're looking at, if your insurance company is managing it, they're paying the drawdowns. If you're hiring a builder, you might be paying cash from the insurance proceeds using your contents and other pieces. You might be looking at a construction loan. The things to be aware of is just, you want to talk to an expert about your financing issues. It's not refinancing, it's your financing issues. And as Todd said, knowing what your options are, will your lender work with you, right? You don't want to enter your 401k into your rebuild, because then you have nothing to retire. You may be using your contents. You might have savings you're using, but talking to your lender about what the options are, right? I know for Kevin and Todd, I know that I know some survivors who have managed to build a slightly smaller house because it's a new and updated house. And so they were able to make it something they could mostly afford because they worked with their lender to get an agreement on, I had a 4-bedroom, 3-bath, 2-story home. I'd like to build a ranch for aging in place. And so it's going to be a 3-bedroom, 3-bath, and this is what I want. And the lender agreed to it because it met the criteria for the value of the loan. So could you gentlemen speak to that concept? Because that's something a lot of people don't think about talking about.
Todd, you want to start?
He's answering a question. And
I was answering the
so if
question.
you could start with that, Kevin.
He's what?
He's in the Q&A.
Oh, okay. I can start. Yeah, I would say at Exchange Bank, I think we saw just about everything from homeowners being way overinsured and had no problem rebuilding whatever they wanted, to the other end, people being underinsured. We had very few people that something couldn't be done for. And that was a very unique situation. We had great success in rebuilding most of the requests that came across our desk. And during the process, that's when people figured out, okay, I think, and a lot of it was, I think I'm going to have this much money from my insurance company. I want to build this. I think it's going to cost this much. Here's what I'm missing. Will I qualify for that? And it can be as simple as that up front when you're just having a general conversation of, I think I may need, I'm getting $300,000 from insurance. It's going to cost me $800,000 to build it. I'm missing $500,000, Kevin. Do I qualify? Yes or no? And then that helps a homeowner decide, do I want to build the same, more, or less? But, like Todd mentioned earlier, a lot of this is just a few, sometimes a few is 3, sometimes a few is 23, it just depends. But it's a conversation up front with the lender just to kind of get the groundwork and see where see where things, stand. Because then the homeowner is able to go back and say, I don't want to get a loan. Now I kind of have the numbers. I'm going to use my personal
Property.
property. Thank you. We had a lot of customers say, you know what? I'm going to use all my personal property. I'm going to get this home built. And then Kevin, I'll come back to you, or I'll just go to another lender, whatever they chose. And I'll take money out of my home then. We saw a lot of people do that, or a lot of people dive into an account that they may or may not want to dive into, but it fit their purpose, it fit their path, and then did some kind of refinancing after. A lot of a disaster, we're talking just about collateral here during a disaster, but there's the other side of the coin there. Does that person still have a job? Did they lose their employer or the place of employment, which just exacerbates a situation? But again, all that starts kind of bubbling up to the surface and talked about with your bank, your lenders, financial advisors, etc.
And Kevin, we do what we refer to as back of the napkin math.
Yeah,
So,
exactly.
You just meet with us. It's a 30-minute conversation. You get the 5 questions answered, like, what's your insurance proceed? What's your income? How much you think it's going to rebuild, And then it's almost like a pre-qual. When you're going to buy your house initially, you go to the mortgage lender, get a pre-qual. How much do I qualify for? This is the same thing that we would do on our end, the back of the napkin math. And, we have learned a lot through this process over the past year. So, use this as a resource, because our job is to try to find a way to do the deal. We want to do a loan and assist people. So we can sometimes be, which is odd to say, bankers can sometimes be more creative than you might think. But I encourage people all the time, give us a call, 30-minute conversation, back of the napkin math, and it will give you probably some direction on how much you qualify for, how much to proceed. We have a lot of information. Use us.
Honestly, I drew a triangle on a piece of paper. On one point was, how much money do you think you're going to have? On one point was, how much is this going to cost? And the difference is your loan. It can start that simple.
Well, and thank you both for sharing that, because I will make the point. Lenders, when they're hearing back from their clients about needs, especially your more local banks in your community, they're getting that feedback loop that says, here's where I'm stuck, here are the pain points, here are the issues. And while every one of those situations is going to be unique, it's like Todd said, you're able to come up with creative solutions, because these are the people you see at the grocery store. You're day in, day out serving them, and you're trying to get them home.
Yeah.
All right, we're going to take a deep breath for a second before we get into construction quality control. All right, I might have taken a shorter breath than everyone else.
I'm still there.
All right. First thing is, and some of the just apologies to anyone if you feel like this is repetitive, but a lot of this is focusing on that bottom line and your budget, and we're talking about this because it's so important to get it right. So once you've determined your budget and your bottom line, now you've got to be careful, right? Looking out for change orders, their impact on your final bill, terms of your contract. What's going to happen if material costs are rapidly changing? How is that written into your contract? Again, going back to, don't let them get ahead on your agreed draw schedule. And then, if it's in your contract, make sure the contractor fulfills that entire contract. So one of the issues, the example here was money for landscaping. It's in the contract to provide the landscaping. And the issue was, oh, well, we've already used that money in another category. It's in the contract. You still owe me that. I didn't authorize that. So I know you two have lots of examples, and I'm sure Annie has some examples here. So I'm going to quit talking for a minute.
So The one thing I'd like to say about change orders, it's not just your bill that goes up, but it also gives the builder more wiggle room as to when you get back home. How much time is added to your build? Do you have enough money in your loss of use to bridge that gap so that they continue to pay your rent? And one of the things that we really learned in our fire was you really need to have your contract reviewed by a contract attorney. These contracts will be made in the favor by the builder. You need a voice for your representation. And a contract attorney can look at it and they can just tell you what's there, what's not there, and what should be there. Bottom line, we have to realize what we don't know and let the experts do the things that will protect us.
I guess I'll jump in next. One thing to make crystal clear to the homeowner who goes to a lender and obtains financing. The lender has a financing contract with you, the homeowner, not the builder. Our purpose is to work with you to get that home built, but we're doing it with your best interest in mind, not the builder. Your contract is with the builder. Ours is not. And the reason I start there is this works in beautifully with working on the budget with the builder, because some of the documentation a lender gets is a whole line item breakdown of all the costs down to the penny. And what lenders also do is lenders put a contingency in extra. You need 500,000. The lender may require you to borrow 550,000. That's they added a 10% contingency for overages of building, change orders, etc. You may change your mind on something and it costs X number of dollars. Well, so you don't have to come out of your pocket with that. We built some of that, possibly some of that, into the loan amount. So the bank is very aware and conscious of what's going on with the budget and how the builder is getting paid. And that third bullet point there, don't let your contractor get ahead of your agreed draw schedule. It's very rare that we're ahead or the builder's ahead by more than 2 or 3 percentage points of where the build is. Because the build gets inspected not only by a city or a county, but by the lender's inspector to make sure that what the contractor says they have done, they have actually done. So that's how the bank mitigates that risk and makes your builder balance that budget with you every month when there's a draw. And some of the deepest education I had to give our homeowners was, how does a construction loan work? The builder does the work first, then they get paid for it. So a builder's got to be able to float some money out there and some expense before they get paid on it. This goes back quite a few screens to picking the right builder and the bank vetting and kind of researching the builder to make sure that that builder has the wherewithal to build, then get paid, then build some more, and get paid again. Because we're trying to incentivize that builder to get it done by only paying for what they've actually built. So this is an incredibly important part of the process here. This is where the wheels come off.
Kevin's there on construction. There's a lot of checks and balances in place to protect the homeowner as well as the financing institution. And I tell folks, let us be the bad guy between you and your builder, because, most likely we've done some deals with them before, we've worked together, can speak the language and stuff like that. So we've had folks that really didn't need a loan, but they got one just for the accounting purposes of maintaining the checks and balances and reviewing the draws and get the lien waivers and all that stuff. It's, which we understand. We've done quite a few of those that just had the proceeds, but they looked at the bank, the credit union, as an accounting function to keep tabs on stuff.
That's a great point, Todd, and a really important one. We did a lot of that as well. to work with the borrower to make sure they were safe, or the homeowner.
I was going
And
to
we-
answer,
Oh,
if you don't mind, I was going to answer one of these questions online that was asked. It's, if someone didn't get a construction loan before starting rebuilding, can they get a loan towards the end of the rebuild? Will there be any Marshall Fire discounted rates? That is extremely challenging to get a loan after the project's partially built or even construction has started. The reason being is title companies, you have to get title insurance to ensure that there's not going to be any intervening liens from any of the subcontractors. And if the process isn't in place regarding lien waivers and copies of invoices and stuff, we've seen quite a bit of that here in Colorado, where they took the insurance money, they start the project, they get halfway started, and now there's no more money, and they're asking banks or credit unions to get involved. And that's very difficult to do. It's not that it can't be done, but it really goes back to the accounting and paperwork that was provided by the builder. If it's a builder that we have a history with, we'll get involved, put them through a lot of documentation requests to verify all that stuff, but the title companies cringe upon that situation.
Yeah, and I want to comment on that too. It used to be the kiss of death to have someone call us and say, "Hey, I need a construction loan. I've started the process," because title was so restrictive of ensuring that there were no liens on the property. And again, I keep quoting the 2017 fire, but there was an abundance of builds that got started because builders pressured the homeowner into starting immediately so they could get their house rebuilt. The homeowners went along with it, ran out of money. And so it's almost the norm. It feels like the norm in our area, to where a lot of the builds have started. And sometimes it's just as simple as a foundation. But as soon as a builder puts a porta potty, for lack of a better description, but a porta potty on the property, that has started construction. Again, another kind of note to talk to your lender about this as well. Again, for us, it's become the norm, and the title companies local are pretty familiar with it. We don't like doing it, but we've done it to take care of the rebuild and to ensure these people can get back in their house. And the one other thing I was going to say on this topic is the reason the lender, as Todd said, you want the lender to play the bad guy, to play dad, or the parent here with the builder, is because we saw time and time again, a builder would request a draw, take the money, and pay a bunch of different job builds that were happening at once, not just for Mr. and Mrs. Smith's home. So the lender doing their due diligence during this budget and disbursement process saves the homeowner a lot of headache, money, time, energy, etc. Let the lender help manage this project with you.
And to speak to what you're talking about a little bit here, also, builders are normally, they're building spec homes with a loan, and they're getting paid in an escrow fashion for completion and milestones. And so when you take that and you transfer that to getting paid in insurance funds, most of them do not have the backing to bridge, and that becomes an issue.
All right, well, thank you all for that. I'm going to touch really briefly on checking your contract. You want to know what is there. You're looking at a project schedule, overhead and profit. What is not there, right? Are there penalties for not being in on time? A finish and end, a start date. And again, just going back to, you're not an expert in this, so know there are things for which you may need an expert. So contract review is typically one of those. And so, Kevin, I think you mentioned that, you've had people come in with a contractor they wanted to work with, or was that you, Todd, that we don't work with them?
Yeah, that was me.
And so, you know, with somebody's bringing it before they sign that contract, would your advice go, you know, talk to your lender and make sure that they don't have a red flag on this person?
Oh, absolutely.
Mhm.
I think the worst thing someone can do after a disaster and the rebuilding is assume that the builder is good to go with the lender, because the lender does have the right to say we're not okay with that. It hasn't happened a lot, but it's happened enough to where it gave pause for the homeowner. And I know in one instance they kept the builder, and I referred them to another lender, and the lender had no problem with it, and they got their house built, which was great. And then I've seen some change builders.
Got it. And just to clarify for everyone in the audience, when I'm saying contract review, you know, that might be an attorney looking at it. Having your lender look at it is a different issue, as we just discussed, that they might be someone that they've had a bad experience with and they're not willing to work with. So, you know, bearing in mind that that is an issue. Todd, anything to add there before I jump to the next slide?
And no, one of the things that is important is on the contract to make sure their contracts aligned with what the draw expectations are on a construction loan. So a lot of times a homeowner will engage a builder, sign a contract, and like Kevin said, we like to pay on work finished. And some of the contracts we were seeing was a good opportunity in which the cost could, they weren't aligned as far as cost and work completed. The builder was looking for large disbursements up front with no work being done. And that's where we were like, we're not comfortable with that. Can you live with this? And we came to a happy conclusion, and they felt better that a financial institution was involved. Their concern was, hey, I'm trying to get this in, trying to get insurance money, but if you have a construction loan or a loan, then I feel better that the draw schedule will be adhered to. So that contract changed significantly, but it was to everybody's advantage, basically.
So there's two quick questions in the chat. What is the current average construction loan interest rate? And this is probably going to vary between your institutions or even the loan and their scores, right? Credit scores.
Yeah, the sad thing right now is construction loans, because our construction loans are tied to prime rate. It's a variable rate over prime. One of the questions asked earlier was, is there a discounted rate for Marshall Fire victims? In our area, yes, there is. We cut rate fees quite a bit in order to assist with that endeavor. But I mean, most of the construction loans we do are 1% over prime. Prime is, I think, 8.25%. So you're looking at 9.25% interest rate, which I know is hard for folks to hear because they may have a 3.5%, 4% mortgage rate right now. So in our market, the typical pricing is 1 over prime, and then there's like a 1% origination fee. An important component to note, though, is on a construction loan, there's two products. One is you pay interest on the amount drawn as you go. So, you know, as you do that first disbursement of 100,000, let's say you get $1 million construction loan, you do that first disbursement of 100,000, you're only paying interest on the 100,000. Next month's another draw of 100,000, so now you're paying interest only on 200,000. You're not paying on the full $1 million until you get to the point that you've drawn the full $1 million.
Yeah, and we're similar to that as well. Most lenders are these days.
Also, if you want, I'll go ahead and answer the other question that's in the thing.
Yeah.
Question is, when do you start the search for lender when you don't have a build estimate yet? What is the right sequence? I have an architect drawing, engineering, and close to getting all details to determine costs, choosing flooring tiles. So is this a time to get lender before submitting build permit request? Yes, it is, because there's two folds on it. There's the element of, you know, your financial wherewithal capacity. Underwriting would look at that, and that's where that back of the napkins. Here's my financial package, which basically is what we call a personal financial statement, a couple years tax returns, W-2, stuff like that. Normal stuff you would also apply when you're getting a mortgage. So a lot of folks will send us that. We'll look at it and say, yep, we don't see any hurdles. You look good. Here's how much we think you can qualify for. And then secondarily, they'll send us the project package, which would be your set of plans, cost breakdown, estimates, spec sheets, stuff like that. So we have found on the Marshall Fire that it's usually a two-step process in regards to financial package, then your build package.
And I would answer that question based on the scenario presented, about when you start to search for a lender, you should be talking to a lender based on where you are, in my opinion. And even if you don't have a build estimate yet, it sounds like you know what you're building, and what I mean by that is size of a structure, and that's when you can start playing with numbers. This is when the triangle comes out. If you're building a 2,000 square foot home at $500 a square foot, assume $1 million. And again, I'm keeping the math real simple. When we had our fire in 2017, homes started at $250 a square foot, and a few years later, those same homes were going for $500 a square foot. So you can definitely, I think it's time to get to a lender based on what you what you described there. And I also want to address Cindy's question if we can.
Yes.
So it says construction loans take 30+ days to approve and fund and have closing costs of 5,000-ish. I don't know if the 5,000-ish is a question or a statement, but and again, I'm in California, and our loan sizes, I'm not sure where Cindy is, but our loan sizes have a tendency to be quite large. But I've yet to see a construction loan anywhere around 5,000-ish. They can be expensive in nature because of all the moving parts, not only with the lender that's involved, but the title company and inspections with title. Title has inspections. A lender is going to have inspections. So they can be an expensive part of the rebuild. Not prohibitive. In 6 years, I've yet to see someone not be able to rebuild because of closing costs. But I think your timing is right, 30, 45 days, sometimes longer depending on permits, but closing costs are going to be a bit higher than that, in my opinion.
Yeah, a rule of thumb we would use is 1% of your loan amount. So if you're borrowing 500,000, it'd be around that amount. But if you're borrowing $1 million, it's going to be $10,000, and that's all the fees that Kevin references. It's title work fees, inspection fees, filing fees, all that kind of stuff. So in our market, 1% has kind of been a rule of thumb on total cost.
California would be quite a bit higher.
Yeah.
Unfortunately.
Well, thank you both for doing the deep dive on that.
Yeah.
Really quickly, just as you're, just cautioning everyone when you're looking at working with a builder, go to, for California, here's the contracts consumer guide that walks you through. Use your state contractor's license board as a resource. You can, validate someone's licensing, making sure that A, they are licensed in the state, and B, they are a general contractor and not a plumber or a roofer saying that they can build your house. Because that does happen. People have a construction license, but they're only in a specific area. And so those things do happen. Also in California, just a note for people, state law is if, when you sign the contract, they can basically, there's a limit of $1,000 for the deposit. They just to be aware of that, whether it's a repair or rebuild, that initial deposit is very limited. For Colorado, a little different. There's not a general contractor licensing at the state level at this point. Most are regulated at the local level, with the communities impacted by the 2020 and the 2021 fire. These are the jurisdictions that would have that information for you. I'm going to go ahead and pop over to the last slide in this section, and then just Annie, I'll let you speak to this, and then gentlemen, please pipe in with anything you'd like to add on the section.
So the quality control in our neighborhood, and we lost 1,440 homes just in our neighborhood. So there was a lot of things going on. And one of the things that just stood out like a sore thumb was the city and the county inspections are to a very low level. The escrow account is generally for milestones. Your quality control, in my mind, would be an inspection company that is beholden to you to show that the work is to the standard that you expect. Inspection companies, 3 inspections, normally it's foundation, close-in, and final. I don't know what they're running today. Then they were running 25 to 3,000. So that's very important for you to know. In California, you cannot sue the inspection companies from the city or the county. You're not allowed to. So there is no oversight there or repercussions. And if they miss something, and it was something major, they had no control to get the builder to actually fix it. So just know that all of the things that you can do to protect yourself are really important. The person who has to advocate for you is you. Temporary occupancy in California, or final certificate of occupancy. In our fire, the city was giving out temporary occupancy permits because they wanted people to get home. They wanted people to not have the financial drain of, rent and all these other things, and especially as the holidays came up. There is a challenge with that. It's getting your builder to actually finish your build. And again, the city and the county really don't have a lot of power to bridge that. So final certificate of occupancy really is the best way to go if you can do it. And lien releases, your contractor should provide you with that. And in California, it's 6 months from the time that subcontractor finished their work. So if it goes beyond that and they put a lien on your property, on your, the tough part is you still have to defend that. You still have to get that taken off. You still will have to hire an attorney, unfortunately, in most cases. So those were some of the ups and downs when it came to quality control in our build. And I'm sure that Kevin can speak to other aspects of it.
Yeah. One thing I want to go back to, I had mentioned that the bank is really your teammate, and your bank is going to be the kind of the controller of the budget with you. One of the things that a bank does, and as part of their construction loan process to incentivize the builder to get the job done right, is they hold what they call a retention back on every draw. So Todd mentioned that $100,000 first draw. A bank will typically hold back 10% of that, $10,000. Put it in a little account for you, okay? Builder doesn't get that. So the builder is kind of behind the 8 ball already. That next draw comes out for another 100,000, bank keeps another 10,000. There's 20,000 now that the builder doesn't have. The bank does that to ensure that that builder stays there and gets the job done and gets it done right. And that's why it may not feel like it at times, but that's why the lender is on your side. That's why the bank is on your side, because they have these kind of processes in place to ensure. And I know it sounds like we're probably painting builders in a bad light. We're not, but I think from my perspective over the last 6 years, Annie's personal perspective, Todd's perspective, we've seen the pitfalls, and we know why we have our processes in place to help you get through those pitfalls. But that first bullet on this screen is where you want to spend extra money. And you want to make sure, because I've seen it where the city and the counties walk through that house and they don't notice a thing. You want an inspector in there on your behalf, knowing how you want this built. It's worth the time, the energy, and the money to get the house that you want to replace or build. So really important topic here.
And I'll just add again, know what your strengths and weaknesses are. If you're not a contractor, you're not going to know what you're looking at when you're looking at the inside. They put the framing up. We don't know how that's supposed to look or what's supposed to be in place. A lot of people in my neighborhood walked their houses and said, looks good. Like they had a clue. We don't know.
Yeah.
Annie, can you share, I just put in a comment about the homeowners who contractor didn't rebuild to current energy efficiencies, which was as simple as not, the framing of the house, instead of being a 2x4, was required to be 2x6s.
So
And-
I'm sorry.
No, go right ahead.
So this house was, it should have failed before permitting, plan check, it should have failed. They had it at 2x4s instead of 2x6s and R13 instead of R19 insulation. It didn't have a chance in the world of passing the T24 energy efficiency. The city missed it. The only reason, so this young man and his family received a temporary occupancy. And moving forward, he had that temporary occupancy for 2 years because it would not pass the test. And finally, another neighbor who'd used the same builder came over to his house because they would take pictures of each other's houses when they weren't there to see. And that's when they realized that it was 2x4s and the wrong insulation, and it was not ever going to pass. And unfortunately, the city referred to the builder and gave him the choice as to how he wanted to rectify this. And his idea was to put solar for the hot water heater per se on the roof. But he had on demand, so it wasn't going to benefit him at all. It was just a way to be in compliance. And that's just how kind of messed up this can get with the wrong builders and not having the right oversight.
Thank you, Annie. And then we have, Todd, this would be a question for you. Is there a way, like at your bank, to have an escrow account without having a loan? How would you obtain that kind of account in Colorado?
That's a great question. We actually get asked that a lot. We don't have that escrow account. Part of it is just, trying to determine the responsibility. We haven't set up escrow accounts because then you get in that situation of when to release the funds, you kind of get caught in the middle without the contract between the homeowner and the bank, or the contract between the bank and the builder and stuff. We have what we've set up, like on a construction loan, we have a controlled disbursement account, but we set that up when there's a construction loan set up. A lot of people have asked us to set up escrow accounts that the money can be put into from their insurance company, and then we would disperse accordingly. And it's like, we don't have that. We don't have escrow accounts. It's hard to set that up. And that's where I go back to some people in those ticket situations said, okay, I'll get $100,000 construction loan to provide for that disbursement account.
So because you're in Colorado, you don't have that, but if they have a mortgage company from another state, will they have access to that? Generally, right?
I think so, yes, but I don't know for sure.
Maybe Kevin would know.
If you don't, I think the question was if you don't have a loan, right? So it's how would you get that?
Yeah, I don't know how you would do that if you don't have a loan.
Yeah, it's a tough scenario to figure out, because earlier I said that, as a bank, we have a contract with you, a loan contract. We don't have a contract with the builder. So when someone comes to us for a construction loan, the builder knows it. the builders, and we have a meeting with the builder to discuss this disbursement process. This is when you're going to get your money and how you're going to get your money. If there is no one doing that on your behalf, because of a loan, it could be hard for a lender to step in to do that because there's no real reason for it. Title company, I'm not sure if a title company out there in Colorado, it could be at least ask that question. That's a tough one. You're kind of in limbo there, in my opinion.
And we have reached out to title companies and they're not offering it either because of the contractual obligation and how do you determine disbursements and who dictates when they get it dispersed and stuff.
Yeah, I will, whoever asked that question, if you will pose that question to UP's Ask an Expert forum. Carolyn, if you put that in the chat, I think there might be an option through Annie with somebody with the National Home Builders Association. I think there were 2 or 3 companies doing some of that. I just don't know what states they're operating. So we can pose that question to them. All right, let's jump to loan options for financing your rebuild. All right, so what do you need to know about construction loans and mortgages? These are the 4 topics we've identified. The conversion of your construction loan to a permanent fixed rate mortgage. If you're going to get a construction only loan, just knowing it must be paid in full or refinance into a mortgage. If you qualify as an owner builder, what those loans look like. And then I'm going to say the bane of both of your existence is navigating SBA and other governmental loans and funding mechanisms. So I'm going to turn this over to you both because I'm sure you have lots to say on this topic.
Todd,
yeah, there are 2 options here. So we offer 2 products. That one is, it's what we call a one-time close. You close on the construction loan. Funds are fully dispersed into that controlled disbursement account. It's essentially like you get a 31, 32-year mortgage because you start making payments from the get-go, even though the house is not done. There's pros and cons depending on everybody's situation regarding which is the most advantageous. The second product is, like you said here, it's a construction only loan. You know, we do the disbursements as you go. You're paying interest on the funds borrowed. When it's all said and done, you have to refinance into a mortgage. I will say probably one of the biggest questions we had asked, and I totally appreciate why people want to do this, is normally if you're going for a construction loan, your first mortgage has to be paid off. Now, that's not to be said that part of the proceeds from the construction loan can be used to pay off your first mortgage, but I understand a lot of folks are coming in saying, hey, I've got an interest rate of 3.5% on my first mortgage. I don't want to pay that off. I only want the gap for the construction loan here. And unfortunately, we're at most, if not all construction loans are in a first lien position. So they have to be in a first position. So that is probably a challenge for a lot of folks because there were some pretty great rates back then that today your mortgage rates are, you know, in the 6 to 7% range. And owner builder loans, we don't do a lot of them, but we do those. You have to be a licensed contractor, general contractor license and stuff. So you have to show that, you know, you have the knowledge. And the biggest thing is that also in our market here, that subcontractors are extremely challenging to find right now. They're all busy because they're looking to rebuild 1,000 homes basically, but they're all busy and stuff. So I would caution somebody to take that course if they've not been active in the building, because subcontractors are hard to come by. And usually when you do come by them, they're going to charge a premium because they're looking at you as a one-time build compared to, you know, Joe the builder that they do a lot of repeat business with.
Okay, I'll jump in here. So we had a lot of customers come to us, and as Todd pointed out, that, hey, I got 3% on my first mortgage. I don't want to pay it off. Okay, that just meant I took that simple triangle that I referenced earlier, and I made it into a hexagon or an octagon. It just had a lot more points. But again, what we did, we sat down, it's like, okay, your mortgage is staying here. So for now, that's going to take a chunk of your money, because until that house gets built, the bank's going to want to hold on to, let's say you owe 300,000. They're going to hold on to $300,000 of your insurance for now. One point is, what other money do you have from insurance? Savings, checking, retirement, IRAs. Where else can you pull money? We had people who had other homes that didn't burn, said, can I take cash out of there? So we had a lot of people robbing Peter to pay Paul. And Paul was to get the loan built or get the home built. And then we just kind of unwound it once the home was built. But there were a lot of people who didn't have all those other points to pull money from. And I just had to look them in the eye and say, you've got to give up that rate. You've got to give up that mortgage if you want to rebuild your home. And they did. And they got their beautiful home rebuilt. The construction only loan, Todd already explained it, pretty simple loan. The conversion of construction, the first bullet point there, we have 95% of our customers getting that, because unless there's an extra cost to get the permanent financing, there is no downsize. And what I like about getting that one-time close, so when you're done with construction, it automatically rolls into a permanent mortgage. You don't have to do anything. You provide the lender with a couple pieces of information, you unlock that brand new door, and you have a loan. Now, depending on where the market is, a year from now, 18 months from now, however long it takes, you may keep that loan, you may refinance it. It is what it is. But your construction loan, if you take a construction only loan, you know you're going to have to refinance that as soon as that build is done. Owner builder loan, just like Todd, we do those. You have to have the proper license and experience. You can't be banker Kevin, who suddenly goes out and gets his contractor's license and goes to a lender and say, hey, I'm going to build my own home. How many have you built? None. They're not going to give you the loan. So you need to have experience in doing that. But if you do, we treat it the same way. SBA loans, a lot of people went out and got the SBA disaster relief loan, incredibly low interest rate, had some quirkiness to how much money they gave you up front and how much you had to take. What we did experience, though, that we, like Todd mentioned, our loan has to be in first place. So, and everyone went out initially and got the SBA loan, then came to us to get a construction loan. We had to work with SBA to get that loan to subordinate, meaning go in behind our loan, be in second place. So we were in what they call first place. That's where the rub is. SBA is a wonderful product. It helps a lot of companies and small businesses, helps a lot of people during a disaster, but the warm and fuzzy ends there. Working with them can be a little challenging and time consuming. Again, do you need to run out right after a disaster and get an SBA loan? Maybe, but slow down, because maybe you don't. And sometimes it's go slow to speed up at the end.
So just so people know, you can apply for an SBA loan and not accept it.
Yeah.
So there's
Yes.
a window there that you want to apply for it. But just know that if as you work your rebuild, you're not obligated.
Great point, Annie. Great point.
And Kevin, are construction loans difficult to get? I had heard that you have to have really, really good credit, that there was different criteria. Is that correct or not?
Honestly, it's not. The criteria really comes on the bucket of information that has to do with the rebuild. We're going to look at financing a construction loan a lot like just if you're buying or refinancing a home. We are going to look at your credit. We are going to look at your income, your employment, your assets, etc. But that's all going to feel normal to you. Is there more risk associated with a construction loan versus a purchase loan or a refinance? Absolutely, because there's a structure being built versus a structure already there. So more of the vetting happens with the budget, the builder's contract, insurance, for I saw someone ask a question for having the proper course of construction insurance. And then the disbursement, and monitoring that bill. That's where a bulk of the work comes in. That's where a bulk of the risk is, because you could be wonderfully qualified for a construction loan, overly qualified for a construction loan. But if that builder messes up, disappears, doesn't build what you want, and you get in a fight with that builder, construction stops, you end up on the front page of a newspaper, then, again, that's where the wheels come off. So that's where the heavy lifting on a construction loan is. It's attached to the builder and the home and all that fun stuff.
Thank you.
Before we jump to our last slide of this topic, we've got a question from Barbara. How long does it usually take after signing a contract for the bank to get the money from insurance for ID and O&L? I know O&L is ordinance and law. Drawing a blank on ID, sorry.
I'm not sure what that is.
I don't know what that is either.
Okay, good. I don't feel so bad. So Barbara, I clarified that. Inflation, thank you. Okay, yeah, the extended coverage, right? So, because from a homeowner standpoint, if you don't have a mortgage, you're having to go through the process to get payment for those, usually once incurred, right? For the extended coverage and the ordinance and law. But for the bank, does it work that way? Or are you able to actually get those funds?
For us, it kind of depended on the insurance company really working. We can get very close to the insurance company, the agent, and all the people behind the scenes. And this is where the homeowner really comes into play because the insurance company, they're releasing those funds depending on that build, percentage done, etc. So there's a ton of communication. But once we hit those milestones, if the homeowner and ourselves as a partner had good, back and forth with that insurance company, it didn't seem to take long, but I do remember some times where, we were waiting 6 weeks on money. That's a long time, but it just varies. I hate answering that way because there's no pat answer. Todd, any thoughts on that?
Yeah, our experience is that the insurance companies were usually lagging. So a lot of our construction loans were to fulfill a gap of the lag from insurance companies. In our market, if a builder submits a draw, we try to turn that draw and make that payment within, days to a week at the most. But insurance companies are looking for additional documentation. And a lot of times the documentation that we get as part of the draw process, we just forward to the insurance company and stuff. And we try, honestly, to develop a rapport with them as well, so we're all on the same page. But a lot of times they're just not equipped to disperse as fast as a bank. So what we would find is we would disperse in a week, that $100,000, insurance company 3 to 6 weeks later would provide that $100,000. So we would reimburse back, or we'd use that $100,000 for the next disbursement and stuff. So our experience is the insurance companies can lag significantly, and that's for the builder. He needs that money to pay his subcontractors. So insurance company seems to lag 3 to 6 weeks has been our experience. And so we just try to fill the gap.
Yeah, and this is where a lender can get into a bind where they overextend on that loan. They get ahead of a disbursement or draw process because they're making up for that insurance money that hasn't shown up yet. And then the insurance money comes in and the lender kind of gets paid back, or everything catches up, so to speak. But again, a lot of communication goes around that part of the process.
Got it. Thank you.
There will be delays though with insurance. I've seen it
Got
every time. Every
So
time.
different types of delays and very subjective to who you're dealing with and what the circumstances are.
Yeah, another great time to get a single point of contact if you can at the insurance company with your claims adjuster, et cetera, if that's even possible. Yeah.
All right. So our last slide on the topic before we do our countdown with our UP slides is gap financing options. So these are the tools that have been shared with us. So gap bridge loans, which are short-term residential loan to meet an immediate need that can be rolled over into a long-term financial tool. A bridge loan or a home equity line of credit, and that would be for those insured against the future residents. So these are two that we know of. Like to turn it over to you gentlemen to talk about what that looks like from your perspective, your institutions, and if there are any other flexible residential lending products that people should be looking at.
That's that's a tough one. Our vehicle of choice that we've been using most is a construction loan. The challenge with the bridge loan is you don't have a structure there to, you have a lot, and ironically in our market, and I bet it's the same in California, that people are surprised by the overall value of their lots, or and Marshall Fire could be anywhere from $350 to $650 in value, and you can lend against that sometimes, just the lot itself. So that's an option. But 9 times out of 10, we've gotten creative with the construction loan that will roll into a home equity loan when it's all said and done, to bridge to help with that. But
Right.
about,
And then if you had a home equity loan line of credit, sorry, obviously you can't get one on a property that is until it's rebuilt, but if you had one before, would the loss of the dwelling lock it down? You know, usually they have a time frame that you can access those funds, but would that close it?
we haven't necessarily, good question. We haven't necessarily closed them out completely. Normally what we've done is reached out, when the fire happened, we did a lot of mapping, went to the portfolio, what loans do we have on the books that were in this area and stuff. And in our instance, we just reached out to all those homeowners, just say, hey, what's your situation? Where are you at? To get an understanding. And it was on a case by case basis, because a lot of times folks were having to live off their home equity line of credit until they could get some resolution from their insurance company and stuff. So that was reviewed on a case by case. It wasn't just standardized that it was locked down.
Got it. Kevin?
Yeah, Todd, it's like you were in our servicing department and we went there. That's exactly what we did. We actually called our customers who had equity lines, and we kept most of them open.
Mm-hmm.
For the pure fact that they just went through this horrific experience. If we couldn't get a hold of people, or they had said, no, I'm going to do X, Y, and Z, sometimes we'd shut it down, but they would know what we were doing. It wasn't a one size fits all. So that was nice that we were able to leave those open. Again, a small community bank has some leeway that the big banks may not have. We also did some when it really depended on that first conversation. How short was someone? What was the gap? And that really painted or put us on a path of maybe we just take a little money out of the lot that's there, and you fill in the that last missing piece of your financial puzzle there. We did some cross collateralization. If they had to borrow a ton or what they call a high loan to value on their rebuild, and maybe that made us a little nervous, but they had another house, we could collateralize that too to make it a stronger underwriting decision. We didn't really give new equity lines out or anything like that, just because that's harder to do. We did create a unsecured line of credit up to, I believe, $250,000. Which was a great tool for people to use to fill in that gap as well. And then we did a lot of cash out refinances on other properties to fill in those gaps. So we tried to be flexible, and again, over the last 6 years with the amount of fires we've had here, we've seen a lot of different examples of what can be done to get someone back in their home. And that's what you're looking for with a lender. If there's one thing I'll say, don't don't work with a lender who all of a sudden rolls out a construction loan because they want to get into that game or provide that service. It's really hard just to start doing construction loans. So be wary of a bank that says, hey, we got this new product. They may not have the wherewithal to provide that team approach to make sure you get the bill done properly. Just be careful on that.
You know, and I was going to share this just from our own experiences here. One of the things that's totally somewhat unrelated to this, but is we know a lot of people in the Marshall Fire lost their vehicles. And today's vehicles are extremely expensive. And what we were seeing is, you know, folks lost their homes, they lost their vehicles, they went out and bought new vehicles or replacement vehicles, and it really messed up their debt to income ratios, because now they've got 2 car loans and they're trying to qualify for a construction loan that'll eventually be a mortgage. So we were surprised at first. We're like, God, we couldn't figure out what was, and then we realized there were a lot of houses that homeowners that lost their vehicles as well. And you throw that into the equation when you're looking at, you know, debt to income ratios, it skewed things significantly.
Yeah, I remember when I bought my house, we were told, no buying cars,
Yeah.
don't buy anything big, nothing on credit, let the sale go through first, right? So it's the same philosophy.
Yeah.
In the chat does Elevations offer an unsecured line of credit up to 250,000?
I don't think we go up to $250,000. I think the max we would probably do is probably close to 100,000.
Thank you.
Well,
I'm going to apply for a loan at Kevin's bank.
You better move to California.
I'd love to move to California.
well, we would welcome you here. Yes. So I'm going to just do a quick wrap here with our last few slides, and then I'm going to turn it back to the 3 panelists and just see if you've got any words of wisdom that you want to share at the end. So for anyone, and I know this feels funny because we offer these yellow books everywhere, but if you don't have one, it's a great resource tool. Please email it to have a copy mailed to you. We're happy to get it to you. On our website, we have our Survivor Speak tip series. Please take advantage of it. And if you have a tip that you'd like to share with other people, how you navigated a certain piece, please feel free to share that information. We're always looking for that firsthand knowledge to save other people from having to reinvent the wheel and go through this. Survivor forums. Annie is our facilitator for that. For our wildfires, we meet the 3rd Tuesday of the month. It's, Annie, correct me if I'm wrong, 7 p.m. Pacific, 8 p.m. Mountain Time. You can register here and talk a lot about the nuts and bolts of how people have gotten through this process and then building a community of caring and collaboration to help people go through this process. So we welcome you to join us at that event. Any insurance issues specifically for Colorado, please take your complaints and questions to Dora at this information here. If you have a question for California, please go to the California Department of Insurance and file a request for assistance. You can call them, go online, or print. Our upcoming Roadmap to Recovery events, go to that events tab on our website, see what's coming up. The contents pricing party is not happening because we are way past January. But we're happy to do that again. If there's a need, you just let us know. Obviously, you see we camp out on a Saturday morning, and I'm yours for about 4 hours. Ask an Expert forum, I mentioned that earlier. Register, it's free, write in your questions, and then we will reach out to our expert network of Team Up volunteers to get you the answer to your question. And this is my last slide. We'd like to thank our funders who support the work and bring us to you today. RCRC, Golden State Finance Authority, the Community Foundation of Boulder County, Community Foundation of Santa Cruz County, and the Ventura County Community Foundation. And I'm going to stop sharing my screen, and I'd like to Obviously, thank our panelists for joining us today, and see if you've got anything you'd like to share with the group before we sign off.
My advice would be just ask. Whether you do business with us or not, we do thousands of construction loans, financing, stuff like that. So, you know, a lot of folks just call, use us as a source, a resource, like you do with United policyholders and stuff like that. Just use us as a resource. We want to see the community get rebuilt. We have quite an invested interest in doing that. So, and no questions shouldn't be asked, because, you know, we've heard it all. We've learned a lot, to be honest with you, going through this process. Have seen a lot of situations and circumstances and stuff. So feel free to ask any question you'd like. We're happy to help.
Yeah, and I would say the same thing. Who's on this, you know, Zoom meeting? I'm not sure where you guys are located, but Valerie and Annie, if you can, you know, you can certainly share all my contact information. Like Todd said, we've been through a lot as lenders. We've learned a lot. I know I talked a lot about the pitfalls, but that's what we come across as a lender. But what I've also seen is the amazing recovery of a community, and the homes and the neighborhoods and the families that were rebuilt. And I feel proud that I was part of that, and I was able to help get these people a construction loan and get them back into their homes. So I know I'm out in California. I don't care where you are, give me a call. I may not be able to be specific to your street or your, you know, neighborhood, but I think I can share some guidance and hopefully give you some stuff to think about to smooth that path that I keep talking about.
And I'll just share that as a survivor, do not let your emotions, as hard as it is, color what you will allow a builder to do. Make sure you do everything you can to mitigate any problems before it happens. It's a lot easier to do it at the beginning than it is in the middle or the end. And we are driven by our emotions. So really, all we want to do is go home, and builders know that. And sometimes they can take advantage of that. So just watch out for each other and make sure you take care of yourself.
Thank you for that. Thank you. Thank you all for joining. And just to echo what Annie said, you know, just like with your insurance claim, treating this as a business transaction, it's a big responsibility. It's a lot of money. It's your financial future, and taking the time to make it, to give it the due diligence and the support and the resources to help you come to that, you know, to tackle this issue. So give yourself the grace and the space to do that. Appreciate all of you joining us today. And I know Annie is typing an answer, and so I'm not going to say goodbye until she posts the answer. But I'd like to thank you all for joining us, and it's so grateful to Kevin and Todd for giving us your time this evening. Really appreciate what you've done for the survivors in your community, and you're making yourselves available here tonight and afterwards for folks to help them get the answers that they need. All
Absolutely.
right.
Thank you guys for putting this together.
Thank you.
We appreciate you all, and like to wish you all a good evening.
Yes. Thank you, everybody.
Thank you.
Bye-bye.
Bye.